Let's see. How about now? My mistake, folks. There's a lot of buttons. I have to press some of them too. It has come to my attention that even some basic option strategies, like covered calls, are not that well understood. So I'm going to go over some of the basics today before we start our usual open mic, where we're going to take your questions today on open interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. What we usually do is sort of get into a couple trade ideas early. Maybe we look at the calendar, and then, for the most part, we take your questions. Over the weekend, I wrote an article about doing a buy right on Netflix. And because on the yield max side, it has come to my attention that some people do not understand this, which is kind of, I know that most of you watching are very familiar with this, but I thought it was probably worth just going over some concepts because they sort of play to a lot of different things in the options world and how we should think about strategies more generally. And of course, we should also recognize that maybe somebody new is tuning in today and they'd like to learn more about it. So with that in mind, I'm going to just punch through a couple slides that I have here on covered calls, go over these topics, and then take your questions, and then talk a little bit about Netflix and kind of how I arrived at that as a covered call strategy. It sort of gives us a framework of things to think about. Okay, so just taking a quick peek here. And I'm, of course, on the wrong slide. I guess I don't normally do it this way, so I'm going to just hop over to this one. Just go over a couple options fundamentals. We're going to define what the covered call strategy is. We're going to talk a little bit about the risks and benefits of covered calls. And in this, we're probably going to get into some options concepts that have applicability to other strategies, some real-world applications and examples. So let's just get right into it. So for those of you who don't know, and I'm sure most of you do, options buyers versus sellers. Options buyers have the right but not the obligation to buy or sell an underlying asset at a set price, known as the strike price, on or before expiration. Or expiry, as it's sometimes known, for American-style options, and on the expiration day for European-style options. Sellers, by contrast, may be obliged to either buy or sell the underlying asset if the option is exercised by the holder. There are two types. There are call options. There are put options. Call options grant the right to buy the asset at the strike price on or before the expiration date, and put options grant the right to sell it. So if we think about it this way, buying a call or selling a put is either a very bullish bet in the case of buying a call, or a modestly bullish one in the case of selling a put. And buying a put is we'll call it aggressively bearish position, or perhaps it can be used as a hedge. And selling a call is a modestly bearish position. The underlying assets to which options may be applied in our conversations almost always are stocks or ETFs, but of course they could include other things. Most commonly, that would be probably futures for most of us if we're not talking about ETFs, indices, or stocks. And, options can be used for everything from hedging to speculative trading to generating income. And that's kind of what we're talking about in this particular example. And because, again, I know most of you guys are familiar, I'm just going to punch through this. The other reason I wanted to do this is because I wanted to show that we actually have a couple different chart types, which I think that our producer Jay has created, which I think are very good for giving us some intuition about how options behave. In this particular example, I'm looking at an example that I came up with this yesterday, so the prices will be a little bit different as of the close right now, but we're looking at the October 660 calls in SPY. Those were trading about 855 as of Friday's close. The top chart is a very conventional, sort of an academic way to illustrate the payoffs for these things. The price of the underlying asset is on the x-axis, and the P&L is on the y-axis. So you can see that if the stock price moves to the right, that is to say if it exceeds the strike price, then you will begin to see that the call will have some value at expiration. And if it exceeds the strike price by at least the amount of premium you paid, then you will get, that's the break-even point. Thereafter, you're going to see profits that behave a lot like stock. But the downside is going to be limited. The lower chart that you have here is just the price of SPY. And this chart is sort of tilted on its axis so that you can see where the region of profit would be versus where the region of losses would be, and the magnitude of those respective profits and losses. Not necessarily to scale, but this should give you some sense of it. Okay. So this is a put. In this case, it was same expiration, the 655s. SPY closed at 650, just under 658, I think, on Friday. So similar graphs, but you can see that the put is obviously making a downside bet, and the same graph is here. I think that also should be fairly self-explanatory. Now, I put this one in. This is just long the 658 call and short the 658 put, which is known as synthetic stock, because this is one of the first areas of confusion that came up when I have been talking to some investors about covered calls, because in some cases you can have synthetic equity positions as a proxy for the stock, and if you're trying to dissect what's going on in some funds that you may be invested in that hold these things, that effectively is just the same thing as stock. The only difference is that you collect interest on the cash balance used to support the position, and you don't receive any dividends because you don't actually own the stock. You own a proxy for it. Okay, this is just another way to look at that. All right. We're just going to punch through some of these other charts that I had here. Okay, so this is a short call. Now, this is important because in the realm of doing covered calls, you can see that the benefit of selling a covered call is going to be everywhere it's green in this image, right? So the curve is instantaneous as we look at this over here on the right, but the straight lines indicate where that option is going to be at expiration. So if you're selling, yeah, let me see. I'm going to give that a try. I just want to make sure that I can, yep, let's see. Here we are. So I'm just going to give a little thing here. So right there, that's going to be the break point. Any instance below this, the short premium strategy, is against stock or just on an outright basis is going to be better off than having not done it. Anywhere above, the opposite will be true. Okay, so let's just talk a little bit now about the strategy. So with a covered call, and this is something that we do a decent bit of. So for those of you who don't know, in addition to talking to all of you and doing stuff on CNBC, I'm also a strategist for Title Financial Group, specifically for the YieldMax suite of products, which are mostly covered call strategies. But it's short option strategies, runs just a little under $20 billion in short options trades there, mostly against long stock. So these strategies, which is one of the most common, as I previously mentioned, is just going to involve owning the underlying asset and selling or writing a call against that asset. To do the strategy appropriately, you need to own the underlying stock or a proxy for it, which is the reason why I showed what that synthetic stock was, because that can also suffice. Now, if you happen to be dealing with these investments, if you're looking at them inside of ETFs, or actually mutual funds too, if they're doing them, understand that those institutions are subject to the 1940 Act. They are classified as registered investment companies, so you're going to periodically see some dynamics associated if you're looking at strategies inside those wrappers that correspond to that, and that will create something that'll look a little funkier maybe than what we're going to be talking about here, but I think that's something to bear in mind. Conventionally, when you do this, you are going to sell calls commensurate with the number of shares that you own. So if I own 100 shares of stock, most call options represent 100 shares, then I would sell one call option, and so on. So as we think about the benefits and risk, what are some of the advantages of doing the strategy? Now, if you remember that first chart I was showing you, that there is a whole area, most of the future price range that we might consider for the underlying asset has some green in it. So it's more likely than not that it creates some benefit. So that's going to be usually thought of as income generation. Because you're long the stock, you might also see some capital appreciation from the underlying shares. You also will get a modest amount of downside protection when you do these kinds of strategies because you're collecting income, and that you could think of that as either lowering your basis in the stock or offsetting any of the gains if there is any of the losses, if there is a capital loss. And then, of course, if the market is going sideways, the benefit here is that you're going to be generating at least some return. Nothing comes free, though. And the important thing to remember in these strategies, of course, is because you own the underlying stocks. In most cases, we are long stocks. Your investment portfolios, your retirement accounts almost certainly are long stocks. When stocks go down, even though you're getting some benefit from selling premium, the likelihood that it offsets it completely is not that great. So you're going to see decreases in value as a function of those falling stock prices. It also caps how much money you can potentially make because you are selling the right to somebody else to buy the assets you hold, presumably at a price that's higher than the one where you own it, but that's going to cap your potential gains. If you have a 5% out of the money short call and the stock doubles, unfortunately, you're only going to see 5% capital appreciation up to the strike and collect the premium, and that's it. So you will have foregone some of those other gains. Now, the reason I bring this up is because the context for the questions that came to me arose out of two stocks that had recent very sharp price appreciation. One was Robinhood, which got added to the S&P 500 last week, and the other was Tesla, which has also seen some really sharp gains in a relatively short period of time. It's nice if you're in a buy right, but you would almost certainly have rather just been long the stock. So we think of that as an opportunity cost. And we can kind of visualize that with these graphics here. So this region in beige represents the enhanced income opportunity that you get. The dotted line is what your P&L would be if you were simply long stock. The bent line with the beige in there, that shows that in many areas, most areas, you're actually better off in the buy right. But the area above the strike price is when you start to see that the benefit is going to be lost, and ultimately could end up becoming what we refer to as that opportunity cost. So this middle area shows that flat market, that's great. You're going to achieve some returns, probably improve the overall portfolio performance. You get a modest amount of downside protection if the stock price declines because you get the premium. You're going to have like-for-like declines on the stock position, but you are going to have a slight offset because of the premium you collected. It's the upside, really, where you're going to have the problem, and that's because you have this capped upside potential. This is going to limit the gains if the stock gets called away, and your profit potential during price increases ultimately becomes limited. Now, as I previously pointed out, you're going to lose less than the stock, but make no mistake, if a stock falls by a very large amount, the mitigating effect of the premium you collect in a short option strategy is, it could be modest. Now, we're going to illustrate, though, that how you affect a strategy like this can have a really big difference. But before we get to that, we can also see that this area up here to the right, and I apologize because I realize this dotted line's kind of faint. That's the opportunity cost. The difference between the dark green line and the dashed light green line is the money that you sacrifice in the event that the underlying asset really takes off. So let's talk about conditions that are ideal for covered calls, because we've been in a fairly prolonged bull market with a couple really bumpy rides along the way, and we need to give some thought to what is the regime we're in. Are we in a good environment for selling premium, or are we in a better one for buying options premium? Well, let's examine this a little bit. What is this first chart here? So in orange, as you would expect, we're just taking a look at the level of the S&P through time. And actually, this is probably a little, some of this got clipped as I'm looking at this now because, of course, we're at all-time highs right now, and you can see that this fell off, so part of this got clipped on the right side, but that's not important. We can definitely bring up a current chart if we need to. The more important point is that the dark line on this chart represents the VIX, right? So we can see the periods where we had bear markets and big spikes in the VIX illustrated here. When do we want to do these types of strategies? In bull markets, moderate bull markets, where realized volatility for the underlying assets is not too great, and the assets are generally appreciating. So this right here, which was just sort of like a snippet of an ideal period of time, what do we have? Markets are just sort of gradually going upwards, and overall volatility is relatively modest. So how do we put the trade on? Pretty easy, and we're going to get into ones that you can take a look at and how I select them. Pick a stock, might be one you own, might not. These are generally going to be stocks that you like, though, because obviously this is the core asset that you're writing against. And again, one call per 100 shares. Just you can make sure that the multiplier aligns. That's the default. There may be circumstances where there are contract multipliers that are a little bit off. So then you have to identify a strike price and an expiration, and then just sell the calls against it. That's basically all there is to it. So, and I'm bumping along through. Let's talk about choosing a stock first. There was some other stuff in there that we don't really need to get into at this point, although I had some slides that I think if people have questions, we can get back to it. So if you already own a stock, and I actually was just talking to a friend of mine. In fact, the stock that we're going to be talking about is Netflix, a guy that I used to work for. It's one of his holdings, one of his larger holdings, actually. And, he has a situation where, his basis in Netflix is $200. He remains bullish on the stock. I like the story as well. 300 million subscribers expected to grow to 400 million by the end of the decade. Very solid top line, bottom line growth. They seem to be solidifying their position in the market. But they're also becoming a more mature company. So where we might have thought of this as, a profound and aggressive growth story, maybe not quite as much now. Now, things to beware of, and actually we talked about this specifically in the case of Netflix right before Good Friday. For those of you who watch this live stream regularly, you'll remember this. You want to be mindful of catalysts, and quarterly earnings reports definitely represent potential catalysts. Can you write through a catalyst? Of course you can. But just be aware that if you're selling a call option that expires just after something like a quarterly earnings release, it's a little bit of a coin toss. You're making kind of a binary judgment call. Now, secondly, of course, you obviously have to make sure that the options that you're looking at, in the case of Netflix, which we're probably going to be looking at here, it's not that much of an issue. Obviously, very liquid. The ideal stocks are going to have moderate volatility, and certainly moderate volatility relative to the implied volatility, which is the other thing. And this is kind of an important point as well, which is I don't see much point in doing covered calls in stocks where the implied volatility is very low. Now, people are of different minds on this. So I've seen people who will do covered calls on the McDonald's of the world, the Procter & Gamble's of the world, and their logic is that the stock might not move very much, and is therefore unlikely to go through the strike of the call that they sell. Okay, I'll go along with that. The problem is that the amount of premium that you collect is quite modest. And the way I look at it, you are still taking equity-like risk because you own the underlying stock. And if you're giving away some potential upside for a very modest tailwind, so modest that it's not really going to mitigate anything to the downside in the event that the stock declines, I just don't really see the point. And this kind of goes to how you choose a strike and expiration, because it's going to play into both of these things. You know, you want to take advantage of the fact that shorter dated options decay more rapidly as a function of their own price. So your standstill yield can look really nice. But there are trade-offs. Longer dated options have less gamma. And I have an illustration here that really brings this point home. And I think it's something to think about depending on your circumstances and depending on whether your interest in selling options comes more from a desire to improve your total returns over time, maybe mute volatility, and actually get meaningful hedging out of a short premium strategy, or if the intent is to harvest this sort of on a regular basis so that you can use those premiums for other purposes. I've seen both. The higher the strike you choose, obviously the more upside participation you're going to get in the underlying asset. But the higher the strike you choose, the lower the amount of premium you're going to collect. So the standstill rate of return will drop. The hedging benefit will drop. So that's kind of the trade-off you're making. Think of this a little bit like squeezing a balloon. You're trying to think about the risks, rewards, benefits, and drawbacks, and sort of tailor it to your thesis. Now, this is one of the reasons I wanted to talk about this, was because this was a little analysis I recently did, which I thought was really quite remarkable. The orange line here is MicroStrategy since the beginning of the year. Strategy. I even put MicroStrategy in here, and I wrote MicroStrategy even though I know that they should have just changed their ticker when they changed their name. Strategy, excuse me. And what we can see, I adjusted both of these to represent $100 invested on the first trading day of the year. Had you done that by this work, you'd be up about 14% year to date if you had bought Strategy, the stock. On the other hand, let's imagine that instead of doing that, you bought the stock and you sold the January 2026 360 call. So MicroStrategy was about $300 at the beginning of the year. That's a 20% out of the money call. How did I get there? I mean, it was kind of a thumb in the wind, but the idea was, okay, well, if you could get 1.5% per month in capital appreciation plus whatever premium you could collect, would that be an attractive strategy? And I think this is really interesting because the first thing you're going to notice is that it did definitely mitigate the downside, right? If you had bought this, the worst case drawdown was, actually I'm pointing to the worst, looks like the worst case drawdown actually would have been beginning of March there. I actually was pointing to the post-Liberation Day lows. But it was about a 6% drawdown. So worst case, you put that trade on, your $100 would have been down to about $94 in early March. Would have been about $95 in the post-Liberation Day lows. As opposed to buying Strategy itself, which we can see dropped considerably more on several occasions. And in fact was down well over 20% on at least 3 occasions. Early March, mid-March, early April. Now, you could say, well, in mid-January, Strategy was significantly outperforming. And it was. At one point, it was up $133 on $100 invested, so 33% within mere weeks. But then it gave all of that back and then some. And that brings me to the next point, which is that the volatility of this strategy is considerably lower. And, depending on the nature of your investing, that may or may not be important to you. But it is a consideration. I mean, for people who are operating endowments or trusts, anything where you have beneficiaries who are depending on the value of the assets, you would much rather have something that looks like the blue line, all else equal, because those types of pools of capital have to contend with the fact that they themselves are short convexity, short gamma, if you will. Why do I mean this? I'll just go over this really quickly. If I run a college endowment, and from that college endowment I am, paying the tuitions of kids who cannot do it themselves, maybe I have to pay benefits out to other sources, and I'm also relying heavily on contributions to the university from charitable givers, alumni, or whatever. Well, what ends up happening is that if the market turns south and the markets roll over, it's entirely possible that the pool of needy applicants to the school who actually will need to depend on some financial aid from that pool of capital is probably higher. Families are out of work. Their savings for college have declined. And at the exact same moment that that's happening, the contributions may be going down because the wealth effect has gone down. People tend to develop alligator arms when it comes to charitable giving when the markets turn south, whereas they, might have their wallets open when they're feeling flush. So consequently, in periods of market duress, it would not be surprising to see a circumstance where their contributions are falling just as the demands on their pool of assets are increasing. And if the value of those pool of assets is extremely volatile and dips precipitously at that moment, that could mean that they're selling those assets at a really bad time. Now, the blue line clearly still goes down in value, but it went down a lot less. So if they had to unwind during a period of market duress, this is a far better outcome. So this is one of the real reasons why non-correlated, uncorrelated, and low volatility return streams are so critical for those types of investors. Now, as it happens, in the example that I'm providing here, the absolute returns, the total returns to this strategy were greater anyhow. So you got lower drawdowns, lower volatility, and higher returns. Like it's the trifecta from an investing perspective when you take a look at it. And I really liked this example because it stemmed from questions I had received about strategies on this stock, and also an article that was published where somebody, I think it was from Bloomberg, might have said that you're better off just buying stocks rather than buying stocks and selling calls. So we have illustrated that ain't necessarily so. So let's talk a little bit here about one of the things that caused this. So as you go further out in time is a value, an important consideration in the value of an option. The further out you go, the more the value of the option will be relative to the price of the underlying asset. That makes sense. But the other important point is that when you annualize returns, because of the accelerated decay of options, the ones at the short end are going to deliver more decay, more theta. So if that's true, would one always then want to sell really short-dated options? And the answer is, unfortunately, that it depends. So here we're looking at a strategy that sells weekly options on Amazon. And what we can see is that the strategy does indeed give lower drawdowns, lower volatility, and higher total returns. But the difference, as you can see, between the white and the orange is not nearly as pronounced as it was with the MicroStrategy long-dated covered call example. So what we can see is that this strategy, when you shorten up the amount of time that you are choosing until expiration, that strategy is going to tend to behave more like the stock does. And it also becomes a little bit more challenging to manage. This is another illustration where we're looking just at that, but this is selling weekly calls on Amazon versus trading the stock itself. A couple things you're going to observe is that while the volatility of Amazon wasn't immaterial, traded down to $75 and as high as 110 since the beginning of the year, so a pretty big swing, I think we can safely say. You know, if you're thinking about it in $100 invested terms, you know, you're dealing with a 35% valuation swing, peak to trough. Notice the price behavior of the underlying asset, that it sort of moves in a trend. This is helpful if you're going to be selling shorter dated covered calls, rather than the really violent swings that we saw in the case of the MicroStrategy example. Okay. So let's see, I might try now, I think, to just advance, see if I can do this or not. Can I bump up to, not sure how do I go to the slides that I really wanted to highlight? I can show this actually on my Bloomberg. You know what I'm going to do, I think, is I'm just going to stop the share here. There we go. And just bring up something a little bit more current. I'm on Netflix now, so why not? So what I'm going to show now is just a distribution of stock prices historically over the course of the last year relative to the normal distribution for that asset. And one of the things you're going to see when you look at this chart is that the actual results, represented by the bars, does not align all that well with the sort of normal distribution. Now, options don't imply a perfectly normal distribution, but there's something in particular I kind of want to draw your attention to. And that is that results around the mean occur with greater frequency than a normal distribution would predict. And moves of, say, up 3.75, 4.25%, I don't know whether my cursor is not showing, but I think that's because of the way but I can highlight some things. I can definitely see that showing up there. So in this area, up 1 to 2 standard deviations, can you guys actually see this? Let me see if, I'm going to try to highlight this, see if that works. Yeah, okay. Now, when I try to use a pointer tool, it often, okay, it's working. So right here, that's 2 standard deviations. And over here, 1 standard deviation, and this is down 1 over here, just in case you guys can't see where those little lines are. So this region right in here, we're going to observe that these types of moves have been happening with a somewhat lower frequency than might be expected. So consequently, it might be an interesting time, therefore, to look to potentially sell some covered calls against it. So which covered calls to sell? So that goes back to that point that I was making before, and I'm going to bring up options play now so we can just walk through an example. Oh, you know what? Before I do that, I wanted to make one other quick point too. And I'm just going to pull up a chart here. I'm going to put some moving averages in. So this point that I'm making right now is that, you know, we're still in a general bull market, and we are arguably still in one for Netflix. I'm going to put in the 150 here. But I did want to point this out, and one of the reasons I thought that maybe now might not be a bad time to sell covered calls is that, this one has topped out before the market did. We're actually below the 50-day. We're above the 150, so we can argue that the long-term trend remains intact. But it does seem to be sort of floundering around here a little bit. So going back to that histogram where I was looking at those periods where the near upside seemed to be happening with less frequency than you might otherwise expect. That's why I thought maybe selling covered calls would be an interesting one. And as I previously pointed out, if you, like my former colleague, have a low basis in Netflix, and even more so if you really just don't want to sell it, I can completely understand that, because in many circumstances that could have a very unpleasant tax consequence depending on your location. Then, potentially selling a covered call is a way to bring your basis down a little bit, mute the volatility a little bit, still maintain some upside, and so on. So I'm just going out here 46 days, and I'm not sure which one I had chosen. I think I was looking at the 1300s, and the reason I was looking at the 1300s was because I noticed that if you sold those, you would probably be selling essentially very close to the all-time highs. So Netflix hit its all-time highs in July. So that would be sort of the worst outcome. So people will say this when you're talking about buyouts, that they hear that a company is in play and that somebody might come along. And I'm not suggesting someone's going to buy Netflix. That's not where this conversation is going. But they will say that a company is in play and where could a potential buyout take place. They will often pull up a chart. And the reason they'll pull up a chart is they will say that, an acquirer is unlikely to pay anything less than a recent high because they need to get the board and the shareholders to go along. And, if you have a stock that was trading $1,300 in the case of Netflix, someone coming along and say, oh, we'd like to buy the company out at $1,200, and they might say, well, I think we're going to hold out just for something as good or a little better than the recent highs. So there was a little bit of a logic a bit like that. But in this case, you are also getting a decent standstill rate of return, because in this particular instance, I think as of the closing price is $31 a share. We'll call it $1,200 to keep the math easy. So that's a little over 2.5% yield over the course of 6+ weeks, and you still have decent amount of upside. You have almost $100 worth of upside to get to the strike. And so the max gain in this particular instance would be $131 over 1,200-ish. So, a little bit better than 10%. Okay. So, having done all that, now, for those of you who I know, and there's a lot of you who are very familiar with these strategies, I apologize if this was kind of a long-winded and boring exercise. But I thought it was kind of important for people to remind themselves that sampling frequency, that there are benefits to both sides depending, right? So we know that shorter dated options decay more rapidly, and there's a reason why people love doing short zero DTE strategies, because whatever you get, the extrinsic premium is going to zero by the end of the day. That's very appealing. But what we can also see is that short premium strategies can have benefits, even if they're very long dated, in circumstances where the underlying asset's volatility is unlikely to be sustainable for that period of time, and where the break-evens become as pronounced as they did in the case of strategy stock. All right. So with that, I am now going to try to grab some questions and go from there. So Ranjana Gupta. Just before its previous earnings, all the guests on Fast Money, including you, were bullish on CSCO. It hasn't done much since. Do you feel the same way now? Let's see. Let's make sure I'm on the first page there. Okay. Well, let's just go back to the previous earnings in Cisco and see what happened. So, was I? I mean, I'm sure I was on right before it. If you say so, the 13th. Let's see what day of the week that was. Curious what because I usually came on Fridays, so that probably means, was I on then on August 8th? Not sure, but it's very likely that we were talking about the stock on August 8th. Maybe the crack production crew can look up the Fast Money August 8th and see if there was an options action segment on it, and we can review what happened there. And let's take a look at how it has done since then. So I'm just going to use the total return calculator here. And it has not done much since. I would actually say it's done worse than not much. It's down 6.6%. And it looks like all of that took place that week. So what's the scoop? Well, let's take a look at their core. Let's take a look at what their top line growth was, because fairly solid, 7.6% on the top line, almost 16% on the bottom line. And if we are taking a look at the full year estimated earnings for next year, we're at 16.7 times forward, and maintaining an okay growth rate. Now, those of you who have watched for a long time, and Ranjana, I know you've watched for a while, will know that generally I like to see fairly compelling valuations when the growth rate is below what I anticipate to be the sales growth rate of the S&P more broadly, which I usually expect, as I've previously articulated, to be, a few hundred basis points higher than nominal GDP growth. So that gets us into at least this 5-6%. So it's at the bottom end of the acceptable range, but it's in there, yeah. And, we also are looking at fairly solid free cash flow growth. So year on year, the estimate, as you can see yourself, you don't need me to do that for you, but I will anyway, more than 20% year on year forecast free cash flow growth with an anticipated free cash flow yield of, well, why don't we just call it 265 billion, 6%. So, yeah. I actually don't mind this stock owned with a short strangle around it, because it's fairly clear it's having a hard time sort of getting much momentum, and that's probably the biggest issue that we have. Let's see what the tech have to say. But yeah, strict business perspective, those things are fine. Totally, it's a mixed bag on the technicals, as you can see. Some higher, some lower. Own the stock, 50% equity position. Actually, the chart's not that dissimilar to Netflix's. Hit its highs for the year in August. Yeah, 50% position in the stock with short strangle. So you sell it if it gets a little bit higher, roll into kind of a wheel strategy, and get a full position on the downside. Now, obviously, the amount of capital that people have is going to influence that, because you have to have 100 shares. That's $6,700 worth. So, if you're dealing with a portfolio that's in the neighborhood of it's going to be tough, because that you're going to start ending up with fairly big concentration, right? Because you can't do less than 100 shares at a time. And if you don't want to have positions much in excess of, say, 5% of the total portfolio, then, 100, if 100 is a half position, then 200 shares is a full position. That suggests that the portfolio size is going to have to be 20 times $13,000. right? Or about $260,000 to be able to support a trade like that. But yes, I continue to be okay with it. All right. PC, when select, oops. Oh, I skipped ahead. FinWest, good morning. Good to have you back with us. How was the Vegas trip? Well, the Vegas trip was it was good. It was very interesting. Robinhood is growing leaps and bounds. They got added to the S&P on the Friday before I headed out there. They have a really enthusiastic team. Vlad is he's a deadlifting CEO that is very enthusiastic, loves his company, and is just very excited for it. And on the brokerage side, they've got Steve Quirk. I've known Q, that's his nickname, for a long time, and he's done some great things in the past. He was, one of the key execs at Thinkorswim, so he's built platforms before. He seems to be just as excited about it as ever. The rest of the dev team are, they're just brilliant. I was kind of reminded of the Vince Vaughn, Owen Wilson movie, The Internship, where you had all of these brainiac interns running around. That's kind of how I felt about the various teams that were announcing their new developments for, what's going to be coming out for them next year. The one that I thought was most interesting is that, and I didn't remember this, but Robinhood started as a social media company, and they became a self-directed brokerage platform and an app, and it's all good. But they really have been thinking repeatedly about how to bring that back, and there's a lot of people in the finfluencer space. I could argue that I guess I'm one of them. People who go and talk on YouTube videos about investing, that are on social media about investing. Now, in our case, we run $20 billion, so it's not very difficult to see our report card for what we do, and you fully transparent. People can see what we're up to. But a lot of other influencers you can't. So is that advice good? Is that advice bad? Hard to know. Professionals do not have a monopoly on good investment ideas. Any one of you could have phenomenal ideas, and we would never know. And we still don't know just because you put it out on social media, because you make a video about it, or buy this or buy that. But their idea, and I think it's a good one, is to tie what people are talking about to real money accounts, so that you can actually get you always get the report card for the pros, because it's all out there, right? We have long track records. I have a long track record of making recommendations. Some of them are good. Some of them, like Cisco on the 8th of August, apparently not so good. But in general, I have a track record out there. What they're saying is, let's give everybody a track record, a real money track record, and let the chips fall where they may. I think it's great. I like that idea. So it was very interesting. That was the good part. The bad part, as all of you will know, all of you know what happened last week with the horrible murder of Charlie Kirk. I didn't personally know Charlie Kirk, and I was only vaguely familiar with the work he did. But, I'd seen some of the things he did. That should never happen to anybody, regardless. But as it happened, that was going down around the time that I was giving my presentation. I was actually moderating a panel on futures trading. And I was going to do open mic, actually, from my hotel room. But I walked off the stage. I got as far as the back of the ballroom, or whatever that was, where this thing was being held, and saw that, and just didn't seem appropriate. I don't think anybody was that interested in hearing my thoughts, and I'm not sure I had any great ones to give at that moment. So it was a good week generally. Obviously a horrible week for that reason. So I guess that's what happens. Okay. So, moving on. PC. When selecting ETFs that harvest implied volatility, besides the underlying assets trend and at IV levels, what other factors should be considered? Please discuss this analysis. So, to me, now this is one of the things that I think is really important. If it's just me, it has to be stocks that I'm interested in. I've long talked about the things that I consider to be sort of crucial criteria on that. On a valuation basis, aggressive growing companies are probably not going to be my top choices because capital appreciation is the name of the game in those. So that's certainly going to weigh into it. Now, something else that can and maybe should weigh into it are prevailing trends for two reasons. They give me a sense of where I want to set strikes and whether or not, if a stock is sort of exhibiting consistent momentum. That's why I actually pulled up that chart with the 50 and the 150. Doesn't really matter whether it's the 150 or the 200, I suppose. Let's get rid of the 100 for a moment. Just blow this out a little bit. Once you start seeing something like this. So here we had a death cross. 50 crosses the 200. Now, if you want to hold that stock, and people would say, well, why would you ever continue to own a stock where you don't expect much from it in the near term? Wouldn't you always be looking for a stock that you think is going to take off? Well, two things about that. One, I don't have a crystal ball. I don't know exactly when the market's going to begin to see things my way. But the second is, that's not the only consideration. There are circumstances where, for the Netflix one's a perfect example. My friend who has it, 200 basis, $1,200 stock, he has 35% taxes on $1,000 a share if he sells it. Because he lives in California, he's in the highest tax bracket and all the rest. That's $350 a share in taxes if he sells it. Well, you could think that the stock is going to trend sideways or that it's going to be soft, but if your holding period is forever, instead what you could do is just sell some upside calls when you think you're entering a more sort of moribund period, if you will. And you'll notice here that when the 50 crossed below the 200 in Cisco's case, that has not been a bad indicator in terms of getting long or short. You would have bought the stock back here when it had the golden cross. You would have sold the stock over here when it had the death cross. You would have bought it over here when it had a golden cross. You would have sold it over here, and so on and so forth. So far, so good. So these are the kinds of setups that I personally like. I will also say that as I previously mentioned, I'm just not that interested in doing this in stocks where I thought NVIDIA was kind of an interesting example when I looked at it, at the big, and the thing is, if it's a growth story, then anticipate that growth. What do you think that if the top line's growing at 15%, and if earnings are growing at, call it 20%, if the multiple stays the same, what's the price of the stock 1 year from now, assuming all of those trajectories remain consistent? Well, choose a strike that's going to be that far out of the money, right? So in NVIDIA's case, obviously it's had a gangbuster year. So here we are, we can say, let's go back to January, okay? So January, round numbers, the stock is 140. The thing is $37 higher than that now. And this is only an example if you're going to do like a 1 year buy right, though, as I previously articulated. Well, what call would you have to sell? I mean, at that growth rate, it's pretty difficult, right? Because the anticipated growth rate of EPS year on year is over 50%. How much are you going to hope to get for a call that if you think that multiple is going to stay the same, maybe you think, okay, it's going to go to a PEG ratio of 1 on the following year's earnings, which is going to be 40, so you use a growth rate of 40 instead and discount it a little bit. But, that probably, I certainly would consider it. And if I had a big concentrated position, as some former employees of NVIDIA do, I've spoken to some of these people. They have huge positions, happily for them. I mean, some have accumulated generational wealth as a result of it because they worked for the company for years, never sold a share, and, it's done wonderful things. Well, selling some premium might make some sense to them. And, those positions, what it reminds me of? It reminds me of the call sellers in natural gas and crude from the producers back when I was on the NYMEX. Their attitude was, look, I will sell 1-year options, even 2, 3, 5. We would see people sell 5-year options in crude. And all of them were producers. They were all saying to themselves, I hope this turns out to be a bad idea. Because that's just going to mean that the rest of my crude position is, whatever I'm producing or holding has gone up materially in value. And in the meantime, they're collecting a little bit of premium. And that could be important, right? For the big holder in NVIDIA, maybe they're looking to take a little bit of money out of their position without selling those shares. Maybe they're hoping to pass it on to somebody else at a step-up basis. So, there's a little bit of, case-specific stuff going on there. But I want a trend. I'm looking for stocks that I think are going to grow but aren't crazy growth rate stocks. Like I said, I think Netflix is a very good example. Actually, how far has Netflix come in the last year? I mean, oh yeah, I see. You're talking about ETFs themselves that harvest implied volatility. I mean, so with respect to the ETFs, I would probably prefer not to use those that employ leverage. That's my own personal preference. I mean, I don't really want to. I mean, I prefer, I think, to talk about the strategy more generally and allow you guys to make up your own mind because, well, first of all, we have a lot of these. Right? I think we've got more than 50. Are we up to 53 or 4 ETFs at this point? And the purpose, I'm not out here trying to hump our own products. Besides which, I'm not sure it's probably illegal for me to do it. So I would say I'm not as crazy about just speaking about the universe in general. I guess that's probably the safest way to address the issue. I'm not enamored of strategies that employ leverage. You can add leverage. I've often had people say, I want to buy options on a levered ETF rather than buying options on the ETF to make, strategic tactical bets. And I would say the options market is quite efficient these days. The guys that make markets on SPY options and on levered S&P options, they're the same people. There's no free lunch to be had. You'll notice that the options on the levered ETFs are going to be more expensive. If you want to use leverage, may you be the person to employ it. That is my recommendation on that. The other is that it has to be, if it's going to be on the single stock space, it has to be on a stock that you yourself would buy and want to own and like. My preference, if you're going to a fund, is take advantage of the fact that fund managers are doing it and let them choose the stocks for you rather than you picking a stock. Because the advantage of this is that you have somebody else managing it on your behalf. Traders are looking at this thing every day. They're adjusting the positions and doing the best they can. Maybe they're outperforming, maybe they're underperforming, but that's what you're paying for. And you almost have kind of a set it and forget it mentality, assuming that you trust their judgment. With the single names, these are great if you have a view. If you like the strategy and you like the stock, and you like the strategy for that stock, then that's a great idea. But then that requires you to maintain that thesis as you go. So, diversified funds, actively managed diversified funds, might be more suitable as a set and forget strategy. My 2 cents, if that's helpful. Not sure if it is or isn't. I hope it is. No audio. Oh, sorry about that. That was my mistake because I didn't hit the right button at the beginning. Okay, thoughts on shorting in the current market. I've recently opened... Oh, you recently shorted. Open Carvana, BES. Okay, so let's talk about that. What are the things we... Oh, no. I upgraded this once before and I didn't like it. I'm going to have to talk to Bloomberg about that. Let's look at it technically first. because boy, have we had a run. So this is how the technical setup for the S&P 500 right now. It's going to be individual cases and things like Carvana and some of the other names you mentioned. It's not necessarily that those aren't proxies for the S&P, but I think we ought to just think about the market generally. It's come a long way. Do we have a lot of warning bells going off? Well, no, not necessarily. But I think we should be aware that, stocks don't grow to the sky, or at least if they do, they don't do so without any pauses or drawbacks, pullbacks, and so on. We're going to be coming into a not terrible season if we can make it past, this. I think I previously said if we can make it past the end of September, I think we're probably in good shape through the end of the year, barring some massive geopolitical event. And that largely was simply because we have the FOMC. The market's clearly trading off of that. Good inflation data, meaning low, combined with modest labor markets, or even moderating labor markets, are supportive of rate cuts. That's supportive of equities. And we've got that coming up. So that's kind of the big thing, right? That's this month. And then we're entering a seasonally strong period for equities. I don't want to compare this to 2000 necessarily, but I would remind folks that, people partied like it was 1999 all the way up until the end of it and a little bit beyond. And the S&P topped out in March of 2000. I'm not saying this is March of 2000, but that's where I'm going to bring the other chart in. Because we can't just look at price action without also taking a look at valuation. How do we want to think about valuation? Well, I'm not going to look at price to book because, our economy is evolving. And, you know what? I'll stick it in there first. Okay, and I'm going to put this in here, but I don't mean to put it in as a scare tactic. So this is where we're at. And that was the 2000 bubble. Now, I specifically mentioned that I don't think this is necessarily the way to think about it. I'm not suggesting that because we are now back to 2000 era valuations on a price to book basis that we're going to have something like what happened starting in March of 2000. And the reason is because this is a very different economy. And, the book value of the businesses that we have today don't necessarily stack up to the kinds of earnings that shareholders are entitled to. So it's not like for like. As the economy has evolved and the largest companies in the country have evolved, price to book may not necessarily be the best metric anymore. It's a reassuring one because it does speak to what you actually own underneath all of it. So back here, when price to book got down to 1.5, that's a pretty nice backstop. I mean, you're basically saying, okay, if on a liquidation basis, I'm only paying a modest premium to all of that to buy this enterprise. So that's attractive, but it's not the only thing. What you're really buying is earnings. And more to the point, you're buying forward earnings. People will look at something like trailing PE. Let's do that first. But to me, trailing PE is also only modestly helpful. It gives us some historical context, but that's not what you're buying. You don't get to buy the company today for how much money they made in the past. Otherwise, when Sears got down to pennies a share, you would have bought it. But they were losing money, and that was that. Okay, so what we're really interested in is what they're going to do in the future. And here's how we look on that basis. Is this a reassuring chart or not? Well, it's not great because we are certainly above average for the past 35 years. That's the bad news. But it's not all bad news because, and I've shown this for anybody who's watching now, maybe you haven't seen this, but for those of you who've watched this live stream a lot, you know what I'm going to bring up next. What I'm going to show is that, earnings growth has actually accelerated. So the compound annual growth rate for earnings per share right now over the entire period is 7.2%. But that doesn't really tell the whole tale because more recently, the number is way higher. And that's not surprising. It's because you've got the biggest companies are seeing epic levels of top and bottom line growth and expanding margins. I mean, there's just this huge secular tailwind. All of that, and that's the other thing that might be, it's both different maybe than in the past, and it could, depending on one's perspective, serve as a cause for celebration or a cause for alarm. And what I mean by that is that virtually all of this is coming from the largest companies. NVIDIA, Microsoft, Meta, Amazon, Oracle, so it turns out Broadcom. So now, a buyer in today's market is really making the bet that that doesn't reverse. And alternatively, you're making the bet, one could argue, that other portions of the economy might begin to catch up. Now, why would they? Well, improvements in productivity will filter down to other publicly traded companies through the course of time. Automation, robotics, AI should create some meaningful productivity improvements, and that's a positive. It's interesting. I was having a conversation with some folks who are in the business of using outsourced technology. Consultants in India, consultants in the Philippines, consultants in Ukraine. And increasingly, they're moving away from that and using AI for a lot of that work instead. Now, I think that's an interesting thing to think about because when you first consider outsourcing, mid to high level jobs to India or the Philippines or Ukraine so that you're bringing the costs down, you could think of that as democratizing. You could think of that as empowering some of these other countries, and you could think of it as a potential engine for earnings growth at the domestic companies that deploy that. The flip side of it, though, is that I think people's experience using those consultants has been somewhat mixed. I worked for a company that used outsourced Ukrainian consultants for development work, and they were phenomenal. They were absolutely great. I've worked with companies that have outsourced some work to the Philippines and India, and I was having dinner last night with somebody who has done the same. His experience was phenomenal. Ours was less so. But AI is proving to be a very powerful tool, and that is outside of technology companies. So everyone's waiting and expecting the hyperscalers to show meaningful results for their massive CapEx. First of all, they're doing quite well already. It's not like the valuations for Microsoft and Amazon and these other companies is so absurd. It's not like Cisco was in '99. So I want to be clear about that. But the results that we might be waiting for and that could potentially justify the valuations that you see in the S&P is when those benefits begin to apply to companies that are outside of the technology space. And I can see I'm kind of running out of time here, but I want to show something else really quickly. And maybe I can punch through some of these questions because I'm long-winded. I apologize for that. But let's take a look at this. Yeah, got Carter Worth pinging me. We'll ask Carter. Oh, he's actually asking. I don't mean to make him jump to the top of the line, folks, but Carter Worth is currently asking me about Unicure options. Bearish, very bearish, as he's asking. So, well above average volume. OC 15 puts, or just opening. Well, maybe the Jans, some of that might be rolls, but so let's say and bearish. I'm just gonna let him know I'm on after the call that I'm on right now with you guys, because I actually have a call with him in the morning. In any case, I think that there is that benefit. So what I was going to show you here, I just seem to have lost what I was doing there. One way to sort of see whether there is some hope that we're going to get this to kind of come together is how the equal weight index is doing relative to the cap weight. Cap weight has been dragged up by NVIDIA, by Broadcom, by Microsoft, all the aforementioned names. The equal weight is, okay, how's everybody else doing, right? And one of the things we can see is that off of these, let's just normalize this. And let's go over, let's just take a look at this low. When is that? That's the Liberation Day low. So this is something I think that's worth keeping an eye on, because this will speak to, are the largest companies, widening the gap, or is that narrowing? And oops, that's the wrong year. This is really what I'm kind of interested in keeping my eye on, which is how is equal weight doing relative to, the market's superstars, and not the world's most reassuring thing going on here either, right? Because what we can see is that the S&P, yes, all, fresh new highs. This right here, it's probably back at like the late July highs. So this is something else I would monitor, just in general, because it speaks to the broader economy. And, trees don't grow to the sky, which I previously mentioned. NVIDIA is a $4 trillion company. Can it grow? Sure. We talked, I think, on a previous live stream about $400 billion or so in CapEx from the hyperscalers next year. Real money. Much of that going to Broadcom and to NVIDIA. But, they can't carry the whole market on their shoulders. And even if they can, that doesn't mean they don't tire at some point, right? Atlas may shrug. So it's a little concerning. Let's see here. Everyone waiting for a rate cut. Should we expect one? It seems to be leaning that way right now. InvestWise, covered call has hurt the most this year for me, losing huge gains and also trying to roll or close the single leg. All right. Well, in that case, I'm kind of glad that I addressed this topic, and maybe we should spend more time on it. Or if you guys are interested, put it into not into this chat, but into the comments for this video. What are the subjects that you are most interested in that you would like us to come back to? And then maybe we can do special, we can focus on that. That way people will know ahead of time, hey, they're going to, really dig into the covered call. I remember at the Wilmot Forum at NYU at the Quorum Institute of Mathematics, there was a series that was sponsored by Instinet, and they had Wilmot come in and talk about, early exercise with puts, which was a fairly basic concept seemingly. But in truth, really understanding it was a far more complex problem than you might imagine. And that's because it's the same thing as saying, oh, I'm going to invest in stocks, I'm going to use fundamentals, and this stock has a PE of 15. It's cheap. Well, that is, it is lower than the market average, and that might be interesting. But there's a lot more to it. And there's a lot more to covered calls too. Changes in volatility and implied volatility, expectations for that, leverage on the balance sheet, which I've mentioned on this channel many times. So each of these things is their own special rabbit hole that we could dig into. But I haven't really spent that much time focusing on an individual strategy, and so I thought I'd give it a go and see how you guys felt about it. But put it into the comments, and we'll try to, work on those in the future. LYFT broke above the 20. It broke its multi-year range as predicted by Carter on August 22nd. And you, well, I guess happily, Bob, thanks for bringing that up so that we don't just have to and Ranjana, don't feel bad about calling me out on the Cisco thing. Not every trade I come up with is a good one, and that's a good example. I have the November in the money 19 long calls already doubled. What's the best strategy to roll up to the 22s? Generally, I like to move up and out. Those are, by my intuition suggests, those are probably well over 60 delta by now. But I'm going to double check that because that's usually the threshold whereby I would be interested. 67 delta. Yeah. So it is time, I think, for you to roll. Well, actually, you're in November, so it's not terribly important to roll up and out, but you might consider it. It's been almost a month anyway, so out to Dece. And, a like moneyness is probably the right course of action. So when you got into those, that would have been back when the stock was... Actually, wow, you were... that was actually reaching a little bit. So the stock's rallied more than I had remembered. So... Was it the 22nd? Okay. Yeah, you might not go as far out of the money as that. I would roll out to December, but I probably wouldn't go quite as far out of the money. That was almost... Look, it worked out. Great. Very happy for you. 20% out of the money. This was a nice win. Don't expect that to happen too often. So a little bit closer. But yeah, take some risk off the table. And you're good. And has switches in the RJ45 fiber will be around for a long time. I'm just going back here on that separate point related to, yeah, I would agree with that. And Eileen, I just really want to touch on this really quickly. I mostly sell puts. I doubt I have enough courage to sell a year-long call, but I'm wondering if you have a rule of thumb you use in determining the strike price, for instance, doubling it. The strike I choose, the longer I go out in time, is a function of two things. The growth rate of the stock, and basically I say to myself, okay, if I assume the multiple is going to be consistent, or if I believe that the multiple is going to drop, let's say I think that it's 35 times and I think it deserves to be 30, but it's also growing the bottom line at 30%. So I'll take my forecast EPS number in the future, the discounted multiple, and so that's factor number one. Factor number two is going to be the standard deviation for the stock itself. If a one-year straddle is going to be 25% of the stock price, so that's the expected move, and I'm thinking that the expected move is to the upside, that's the second factor. So then I'm going to take a look at the implied volatility and make sure that my expected rate of return is going to be, and this is going to rule out a lot of stocks, folks, is on the short option side, is going to be commensurate with taking an equity risk. So that's wholly independent of the stock, which means that that option is going to have to be pretty expensive, as it was in the MicroStrategy case, as it was in the Netflix case. Not surprising, those are high volatility stocks. So, but the reason, the Alex V, you were talking about the kart racing. Yeah, they had it at the Formula One thing on that first night. They offered us an opportunity to jump as speakers. They said, the speakers can go right to the front of the line. I didn't think that was polite. And I've been out on the Las Vegas Speedway, not in go-karts, but in BMW Z4s. I like motorsports as much as the next guy, but those go-karts weren't for me. Those were for the attendees, and a number of people got out there and had a good time with it, and I'm glad they did. It looked like fun. What do I think of Trump advocating for the end of companies' quarterly earnings reports? No thanks. I want quarterly earnings reports. If you asked me to sit here and make a 20-minute case for having them less often, I could do that. I could say that companies should be focused on long-term operating results. But in the long run, no. More frequent transparency is just better. So I'm not crazy about that. I don't know how you guys all feel about it. It is a little bit of a, look, it's a resource hog, but we need transparency from these companies that they can do it. We've been doing it long enough. I don't think we need to change that, so I'm not for that. Just on the Eileen point, though, selling puts, the big distinction is that selling cash-covered puts and covered calls, which have similar risk characteristics, stocks that I'm kicking the tires on are where I like the cash-covered puts, because you could own it at a discount and you're saying, okay, I'm going to work my way in this way. But stocks that I think are on a good growth trajectory, I kind of want to own the stock and sell upside calls, because while the characteristic is similar, I have more upside, and I'm expecting it, right? Because I think the underpinning equity is worth owning. So with that, I have chewed up a lot of your time, and I realize going through slideshows is maybe not the most fun in the whole wide world, but I just wanted to give it a try, see what you all thought, and say that sometimes getting back to basics is helpful, just so we kind of remember how options behave and how different circumstances fit different strategies a little bit better. Hope that helps. Thank you all for watching, and barring something unexpected, we'll be back here on Wednesday, 4:15 Eastern. I hope you join us.